Hey everyone, welcome back to Corporate Decoder, the place where we try to make sense of the money world, and sometimes the money world is really not making sense. Today we're diving into an amendment to a Form 8K filing from Chatland, and let me tell you, it's quite the adjustment. Think of it like finding a typo in your bank statement and then realizing the typo was actually about a lot more money than you thought. Mitesco Inc. is filing an amendment to a previous report, and this amendment is dated July 21st, 2025. Now, this type of filing, an 8K, is generally for announcing big, significant events that shareholders need to know about pretty quickly. An amendment means they are correcting or adding information to something they already filed. So what did they miss or get wrong the first time around? Let's jump straight into what seems to be the main event here. Mitesco entered into some pretty important financing agreements specifically related to FY 2025 bridge notes. So what does that mean? Essentially, the company needed cash to bridge a gap, likely until they secured more permanent funding or revenue came in. On May 19th, they got $100 from two institutional investors. This money was actually funded on June 22nd. These weren't just simple loans. These were senior secured 5% original issue discount promissory notes. Let's break that down. Senior secured means these lenders are pretty high up in the pecking order if things go south. They get paid before a lot of other people. 5% original issue discount sounds a little confusing. It means the notes were sold at a discount, so the $100 in owes they can upfront fee or interest. So they received 10 of the term. Now here's a kicker. These notes don't actually charge interest on the principal unless an event of default occurs. If an event of default does happen, then interest kicks in at a whopping 15% or whatever the maximum legal rate is. And these notes have a 12-month term. So what counts as an event of default? Missing a payment, breaking a promise made in the agreement, a significant negative event happening to the company, failing to report to the SEC, or even losing their stock trading status. If any of those happen, the notes can be converted into common stock of the company, which could be really bad news for existing shareholders as it dilutes their ownership. So this financing was done not through a public offering, but under Section 4(e)(2) of the Securities Act. This usually means they sold these securities to sophisticated investors who are considered accredited, meaning they have a certain level of income or net worth. This is a way for companies to raise money without going through a full public registration process, which can be expensive and time-consuming. Next up, we have dividend payments for their Series X preferred stock in the second quarter of fiscal year 2025. The company has 19,103 shares of the Series X preferred stock outstanding, with a total face value or stated value of $492,575. This preferred stock pays 10% annual interest. The interesting part here is how they pay this interest. Instead of cash, they can issue restricted common stock. The price for this stock is based on the closing price on the 15th of each month. In Q2 FY25, Mitesco issued a total of 33,347 shares of restricted common stock to pay these dividends. These shares went to specific investors. Leth received 4,063 shares, Metchelt received 4,063 shares, Valensic got 4,063 shares, and Anglo-Irish got a much larger chunk of 21,000 Wavoshians to two Ford shareholders. Now, let's talk about the Series A preferred stock. This was part of a restructuring plan from fiscal year 2024. Certain note and security holders received this new Series amortizing convertible preferred stock. Each share has a stated value of $25. Holders can convert these shares into common stock by dividing the stated value by Fortis conversion, which is the conversion price. They can convert any time, or the company can force a conversion if certain conditions are met. More importantly, the company plans to redeem these shares monthly, starting in January 2025. They redeem 1/36 of the remaining amount each month. This redemption can be in cash or common stock. If it's cash, it's at 105% of the original price. If it's common stock, it's at a 10% discount to the average of the 5 lowest closing prices over a 30-day trading period. The company intends to accrue these redemption shares monthly and issue them quarterly to reduce expenses. In the second quarter, Mitesco issued a total of 402,451 shares to redeem 121 worth of its Series A per stock. The recipients were Pince Capital with 76,504 shares, GS Capital with 2026 hits 1,005% total holdings. This is likely to avoid triggering certain reporting requirements or investor notification rules. Heftevu with 29,280 shares, and Cavalry Mercer CM with an aggregate of 2714 requirements or investor notification rules. Let's look at who really controls Mitesco. Based on the issuances mentioned, the total number of common shares outstanding as of June 30, 2025 is 11,742,800 to 42,842,807 to 42,100 of ownership. For Zedgero's major shareholders, Mac Leth, who is the CEO, CFO and chairman of the board, has a total of 1,341,477 votes, which represents 6.84% of the total voting shares. This includes common stock and super votes from preferred stock, and interestingly, he also has shares from a family member related to a software business acquisition. Jordan Balincic, a board member, has 1,226 un-44 votes, making up 6.22% of the total votes. Another board member, Jim Clifton, is listed with 0 ownership. As a group, current executive officers and directors, totaling 3 people, hold 2,562,121 votes, or 13.06% with 0 ownership. As a group, current executive officers and directors totaling 3 people hold 2,562,121 votes, or 13.06%. Now for the major shareholders. John Mitchell, a former board member, holds 1,266,086 votes, giving him 6.45% of the total votes. But the big player here is Anglo-Irish Management LLC. They hold a staggering 5,184,641 votes. It's definitely something to keep an eye on. It means a relatively small number of entities have significant control over the company's direction. Finally, in terms of what's attached to this filing, we have Exhibit 10.1, which is the actual form of that senior secured note we talked about earlier. And then there's Exhibit 104, which is tagged for the cover page interactive data file, meaning it's formatted in a way that computers can easily read and process the information. So wrapping it all up, Mitesco Inc. is clearly in a phase of financing and restructuring. They've issued new debt with some rather strict default clauses and used stock issuances to manage dividend payments and redeem preferred shares. This all points to a company navigating a lean period, using creative financial instruments to stay afloat and manage its obligations. The significant stake held by Anglo-Irish Management and the key executive and director ownership percentages paint a picture of a company where control is quite concentrated. Now here's my take on Mitesco. The company is clearly relying on bridge financing and convertible notes, which are often signals of financial strain or transition. While the use of stock for dividends and redemptions can help conserve cash, it also means significant dilution for common shareholders. The default clauses on their debt are particularly concerning. Any minor misstep could trigger much higher interest rates and potentially conversion into equity, further diluting ownership. The heavy reliance on Series X and Series A preferred stock suggests a complex capital structure. The large ownership by Anglo-Irish Management could be a strength if they are stable investors, or a risk if their interest diverts its operations and generate consistent revenue to avoid further financial distress. A key risk is their ability to meet the terms of their various agreements and avoid default, especially with the tight timeline on those bridge notes. The overall direction seems to be focused on survival and restructuring, but the path forward carries significant risks for common shareholders. What do you all think about Mitesco's latest filing? Does this kind of financing structure make you confident or concerned? Let me know your thoughts in the comments below. If you found this breakdown useful, please give this video a thumbs up and subscribe for more regular dives into corporate filings. And don't forget to join our Discord community. The link is in the description for more discussions and insights. Thanks for watching, and I'll see you in the next one.